In the 1980s, Japan was at the center of the global economy. Tokyo's land prices skyrocketed, and the Nikkei 225 index reached an all-time high. Japanese corporations were expected to dominate the global market. However, all of this was built on an economic bubble. After the bubble burst, Japan suffered from over 30 years of prolonged economic stagnation, maintaining an ultra-low interest rate policy. Recently, however, the Bank of Japan has raised interest rates, signaling a shift in economic policy. Today, we will explore how Japan's economic bubble formed and collapsed and examine how the Bank of Japan's latest rate hikes and the unwinding of the yen carry trade could impact the global economy. Japan's economic bubble began forming in the 1980s. At the time, Japan recorded massive trade surpluses in the US and European markets, driven by its semiconductor and automotive industries. However, to curb Japan's growing economic influence, the US and other major economies signed the Plaza Accord in 1985. Following the Plaza Accord, the yen appreciated sharply, reducing the competitiveness of Japanese exports. To counteract this, the Japanese government aggressively lowered interest rates and introduced economic stimulus measures. As a result, capital flowed into the real estate and stock markets. At the time, there was a widespread belief in Japan that land prices never fall, leading to a speculative boom in real estate. By 1989, land prices in Tokyo's prime districts were so high that they could have bought all of Manhattan. The Nikkei 225 index surged past 38,000 points. However, this economic boom was not driven by real industrial productivity or innovation, but rather by speculation and low interest rates, making the eventual bursting of the bubble inevitable. To curb economic overheating, the Japanese government began raising interest rates in 1989. The Bank of Japan increased the benchmark interest rate from 2.5% to 6%, and banks started restricting real estate loans. As a result, property prices plummeted, marking the beginning of the bubble's collapse. The stock market was also severely impacted. By the end of 1989, the Nikkei 225 index stood at 38,957 points, but within 2 years, it had crashed to below 20,000 points. As real estate values declined, the collateral held by corporations lost its worth, further weakening the financial sector. Many Japanese companies, believing in ever-rising land prices, had taken out massive loans to fund investments. When property values collapsed, these businesses could not repay their debts, leading to a wave of bankruptcies. The economy entered a steep downturn, ushering in what is now called Japan's lost decade. After the bubble burst, the Japanese government tried to revive the economy by lowering interest rates once again. However, in a climate of severely weakened consumer and business confidence, low interest rates failed to stimulate investment and spending. Instead of expanding, corporations prioritized survival by implementing restructuring measures. The labor market became rigid, leading to the so-called employment ice age. By the late 1990s, Japan's unemployment rate had reached a historic high, and consumers focused more on saving than spending. In response, the Bank of Japan introduced an unprecedented zero-interest rate policy and launched quantitative easing programs to stimulate the economy. However, Japan remained trapped in a vicious cycle of low growth, low inflation, and low interest rates. This prolonged stagnation further distorted Japan's economic structure in the long run. Recently, the Bank of Japan raised interest rates for the first time in 17 years, marking an end to its long-standing ultra-loose monetary policy. This move signals Japan's attempt to break free from prolonged deflation. However, Japan's rate hikes also have significant implications for global financial markets. One of the biggest effects is the unwinding of the yen carry trade. Yen carry trading involves borrowing cheap yen at ultra-low interest rates and investing in higher-yielding assets abroad. Since the 2000s, this strategy has directed vast amounts of Japanese capital into US, European, and emerging markets. However, as Japan raises interest rates, the yen strengthens, and borrowing costs increase. This means investors may start liquidating their foreign assets and repatriating funds, reducing global liquidity and potentially destabilizing emerging markets. Additionally, as Japanese corporate debt becomes more expensive, businesses accustomed to low borrowing costs may struggle to adjust, potentially triggering unforeseen economic instability. The collapse of Japan's economic bubble serves as a cautionary tale about the dangers of excessive real estate speculation and prolonged monetary easing. While ultra-low interest rates were meant to revive the economy, they ultimately contributed to long-term stagnation. Japan's recent interest rate hikes could mark a turning point in its economic trajectory, but they also pose risks for global financial stability. The world now watches to see whether Japan can finally escape its prolonged recession and return to sustainable economic growth.